The only real way to make money inside financial markets is to make sure that you are synchronized. To be synchronized, you need to understand the intercorrelations and interconnections between Tier 1, Tier 2, and Tier 3 charts. Then you need to understand where smart money is buying and selling. In this video, I'll answer community questions. I would also love to hear your questions. Let's run the numbers. JM from Twitter X asked, "You have covered the DXY multiple times, but what interests me is the zoomed out DXY. Is it hitting resistance? It seems like a long way down if it is." Thank you, JM. Let's do that zoomed out view for you. You can see the DXY. What we're looking at are 12-month candles all the way back to 1967. When we look at the resistance inside the DXY, just say we take this specific line, we can already see the DXY overcame resistance, and it did so in 2016. It retested in 2018. It found a bit of a bottom in 2021, and it's resumed upwards now. We can also see that the DXY is being supported. First support, second support. It's not looking too bad in terms of appreciation in the DXY. Rule 605, indicators follow CTKS method predicts. As a former lecturer in first and second year statistics, one of the subjects that I took was descriptive statistics. It's all about standard deviations, averages, medians, modes, all sorts of weird and wonderful things. The problem with moving averages, they're highly distorted by outlying values. What you see here is a simple moving average. It's in fact the daily moving average, the 50, the 100, and the 200-day moving average applied across the DXY. You can see when it's zoomed out like this, it becomes very obvious that indicators follow. To get a moving average, you have to calculate backwards. Having been in financial markets for nearly 40 years, one of the things that I saw, and of course coming from a background teaching statistics, moving averages when it comes to entry and exit positions is really fraught with a lot of danger. That's why I invented the CTKS method. The major problem that we face as investors and traders, all charts are intercorrelated and interconnected. The DXY does impact everything. That's why it's a Tier 1 chart. The CTKS method helps us to understand, are there safety nets below price, and where are they and how strong are they? What about the ceilings above price? Where are they and how strong are they as well? This literally gives you X-ray vision into the market. We're going to have a look at three-dimensional risk management using the CTKS method to plot out a path where the DXY is currently going. Is it following an upward path, a neutral path, or a downwards path? And we're going to look at structure as well. Currently, the DXY is trading at 104.8920. When we look at this specific price action, there is always supply and demand inside and underneath the chart that we view. That supply and demand is always tied to structure. For example, when I pop on the indicator, what do we actually see? There was smart money buy areas from that 104 downwards, and there were quite a few of them as well. When we had and struck internal resistance inside the DXY's chart between 104.504 and up a little bit to 104.5303, we saw a powering and then a retest of that area. These areas are called Stanfield levels or SLs. Price is always moving from SL to SL. If it can't get above, it's going below. If it can get above, it's going to the next one. What did we see? We left this area of smart money buy support around that 104.5200 mark, and then we came up and challenged the 104.8684. What happened then? We couldn't get above it, and it's been retested, and now we're starting to make our way. What do we know about price action and how it works? If you get above an SL, it's going to the one above. If you can't get above this SL, it's going to the one below. Where is the next one? It's up here at 105, 1989. The important thing to understand, these structural support and resistance lines have been drawn up on the DXY since 1967 with a standards-based process. They are very significant. They're not recent indicative price. They're all of price. Smart money knows there are multiple levels of support and resistance inside market structure. And market structure is very, very important to look at. I can't stress it enough. Because you can see this is where price will hit a ceiling. If it's not coming back to the floor, it's going through the ceiling and up to the next ceiling, seeking to convert that area to a floor. When it comes to support and resistance, there are multiple levels of support and resistance, not just one. JM, I hope this helps to answer your question. And if you learn the CTKS method, you'll be able to identify these areas. You'll be able to draw them up on your own charts. Rule 446, all markets are intercorrelated and interdependent. It's very easy to look at just one chart, and that's what retail does. They're only interested in the charts that they trade or invest in. This is a huge mistake because all of the charts are intercorrelated and interdependent. What happens with the DXY is playing out on all of the charts, even as far away as crypto. Crypto Scotty from Twitter X had the question, how do I recognize when I'm in or out of sync and what may be the cause? Thank you, Crypto Scotty. I'm going to talk about this in terms of intercorrelation and interdependencies between charts. When it comes to synchronization, being in sync with the market, and that's very important because the market pays when you are synchronized. If you're not synchronized, you pay the market. That's the first way that you can tell if you're in sync or not. The second way is to understand all charts are intercorrelated and interdependent. What I'm just releasing here is a view of the three-dimensional risk management that we apply inside the service. You can see for the NASDAQ, it's basically following a consolidation case and slightly weak. These particular paths are drawn out using objective dynamic market structure, which is the foundation of the CTKS method. This creates CTKS structure or all the support and resistance levels pertinent to that specific chart for that month. The first thing to understand, which direction is a specific tier 1 chart going in? Is it consolidating? Is it positive or is it negative? Charts are always changing character. That's something to be very, very aware of. When we look at the NASDAQ, the tech index, what we can see is the NASDAQ was coming down. It found smart money support at 13,857 and also at 13,808. What is occurring in here, these SLs or Stanfield levels, indicate where smart money is stepping in to buy and to support price. It's very important to know where the safety nets are. These are safety nets, and where the ceilings are. We can see at around that 14,206 level, 14,207, that's quite a substantial ceiling. It's going to be hard to get through that ceiling. In fact, the NASDAQ did try, but it had negative air. Negative air always shows that the sellers are in control. They're trying to push the price back. When it comes to negative air, it means that the price cannot get up to this smart money sell area. The sellers are too powerful. What does that mean? Price is always moving SL to SL. It means that we expect the lower SLs to be activated at some time, and that's exactly what occurred. The first thing to get in sync with the market is to know where the SLs are. If you do not know where the safety nets and ceilings are, you're literally just guessing. And you know that indicators do not help. One of the fastest ways to get out of synchronization is just read the media. The media is full of terror. That's how they get you to buy in the first place. There's all sorts of media, and of course the media is important to keep your eye on, but don't get to a point where you read something and you want to go and run and hide under your bed because the sky is falling. The media is like Chicken Little. The sky is falling, the sky is falling. Unfortunately, the sky is always falling to the media. The media is there to get eyeballs, to get people to look at their print and attract advertisers. Please do not confuse the media's objectives. Another way to keep in synchronization is to follow the CTKS price paths inside the service. What this is, we do three-dimensional risk management every single month, and when I release a video explaining what the different support and resistance levels are from a structural perspective, I always mark up this three-dimensional risk management. At the moment, we can see the Nasdaq is neutral to slightly negative. The importance of this is not to get these exact lines right. That's not what the purpose of three-dimensional risk management is. The purpose is to understand the Nasdaq is currently not positive. The fastest way to get out of synchronization is to just get into trades and investments without knowing what the Tier 1, Tier 2, and Tier 3 charts are doing. If you do not have rules, it means that you're trading and investing emotionally and not with a specific strategy. A lack of a strategy will always desynchronize you. From the CTKS method service, we understand that the DXY is encountering resistance at the moment, but it's following a positive path. It's not following a consolidation path or a negative path using three-dimensional risk management. And this is all explained inside the service, inside the videos. Typically, when US oil comes up, that's not so good for the economic system. It makes the cost of freight, the cost of transportation more and more expensive. It eats into profit margins, which lowers shareholder returns. By definition, that lowers the amount of money that's floating around the economic system and hits GDP. If inflation gets out of control, that means the Fed will come in and raise the federal funds rate. That increases the cost of borrowing. You can see oil is a chart to watch. If it's going up, that's not so good. And we can see from the three-dimensional risk management curves inside the service, oil is currently following a positive path. Oil is likely to get a headache because when we pop on the indicator, we can see that around 88.08 is a confluence of smart money sell levels. There's also one above. We would expect oil to encounter resistance around these levels. Smart money should be pushing the price of oil down around this area. This is exactly why we need to understand where smart money is buying and selling. And you can see there was a fresh air gap between the smart money buy level at 86.20 and the smart money sell level around that 88.08. When you've got fresh air, that means the price can move very, very quickly up to the next SL. Junk bonds indicate risk-on or risk-off behavior. We can see that junk bonds under three-dimensional risk management are following a negative price path. This means the heat is coming out of the market. People are getting concerned. This will be reflected in downward negative price momentum on the Nasdaq, the S&P 500. And if the Nasdaq and the S&P 500 are coming down, you can bet those stocks are coming down with it. But of course there are different sectors and we need to be aware of sector rotation inside the stock market. But junk coming down is not good. We always need to know where smart money is buying and selling. Is junk just hit a huge level of structural support or is it under structural resistance? This means something. In order to be synchronized, you must understand where the structure is. Zooming into this area is structure just underneath here, and junk bonds have been marked up since 2007. Let's pop on the indicator. Oh no, that's not so good, is it? Basically, at 91.33, there's a smart money structural sell area. There was a buy area, it caught price, but now it's turned to a sell area. If junk bonds can't get above this 91.33, it's going down to 90.91. Please let me know in the comments. Of course, if you have any questions, I'm very happy to cover them in the daily video. Also, a bit of a question for you. If you see junk bonds starting to come down and test this lower SL, what do you think will happen to the stock market and the stocks inside it? If you're inside the stock market or commodities and you're not looking at junk bonds, you're missing out on a huge, fantastic indicator of risk on or risk off activity. Another key chart to look at is the US 10-year yield. It's very important. And when we look at this yield, is it on a positive consolidation case or a negative case? It's pretty obvious that it's on a positive case, but these three-dimensional risk management lines are drawn up from the start of the month and then they're not changed. What we've seen is a couple of things. The DXY has just broken out, but we saw that it hit structural resistance. Junk bonds are going down. Is the DXY and the US 10-year yield, are they about to get over some form of resistance? The only way to answer this question and get synchronized in with the market is to know where the CTKS structure actually is. We're currently seeing a lot of strength in the US 10-year yield, and the smart money once sell areas are being converted into buy areas from 428.38 up to 429.02. There's a bit of fresh air, so we could see an upward progression to 431.36, but we can see we are following the positive path for yields. Being aware of key events is very important. World stock indexes fell while the benchmark US Treasury yield rose and the US dollar hit its highest in 6 months after stronger than expected US services sector data suggested inflationary pressures are remaining. The Institute for Supply Management (ISM) said its non-manufacturing PMI rose in August, with new orders firming and businesses paying higher prices for imports. If inflationary pressures get baked into the economic system, the Fed will be forced to increase the federal funds rate. Jerome has talked about this ad nauseum, which means all the time. The yield on the benchmark US 10-year Treasury note rose 3 basis points to 4.298%. The yield has risen about 21 basis points over the past 3 sessions, its biggest 3-day gain in about a month. Yields and the DXY frequently push gold's price around. This is something that you need to be aware of. And we can see from inside the service, currently gold is starting to follow a negative path, and that's not surprising as the DXY follows a positive path and yields follow a positive path as well, and also the major indices following a negative path. Gold lost its smart money buy area at 1925.77. It's been currently caught by that 1919 area, but it's looking a little bit weak. If we lose the 1919, we're coming down to 1911. And if you want to know all of the structure, you see it inside the service each month with a video explaining where price can go. The S&P 500 is incredibly important to understand. Right now, we can see the S&P 500 is following the negative path, but we need to understand where is structure, where is CTKS structure inside this chart. To do that, we apply the CTKS method and mark up price history from 1871. A lot of people don't have the time to mark up the Tier 1, Tier 2, and Tier 3 charts. That's why the surface exists, to save you an enormous amount of time, but also to make sure that you're getting the greatest accuracy possible. When looking at the S&P 500, it didn't help that an economic report came out and said, maybe we've got inflation for longer, and that means that the Fed is likely to raise interest rates. But we can see from the statistics that that is actually not the case. But anyway, news will have their stories. What we need to understand is how the charts are actually working. To keep in synchronization, we need to know where the smart money is buying and selling. In the S&P 500, that 44.93 was a structural support level, and we lost it. What does that mean? If it's not going above, where's it going? You got it. It's going to the SL below. Price is always moving SL to SL. Doesn't mean it just necessarily goes straight there. Sometimes it does, but it depends how much resistance is between the two SLs. We can see that that lower SL, which is a smart money buy area, is 44.39 and 52 cents. This fresh air gap caused the S&P to drop. When you see big fresh air gaps, you've got to be a little bit concerned because price has no support in those areas. When a fresh air gap is above current price, wow, that's a party time. Unless, of course, you're shorting, in which case you could get absolutely wiped out. So you can see, it doesn't matter if you're going long at spot or you're using leverage, you must know where CTKS structure is. Getting your X-ray vision is really important. As you get in more and more synchronization with the markets, days like this, when it's red, will hold excitement, not terror for you. Smart money thinks opposite to retail. The red is really good because you get on the right side of the percentage, but you must know what you're doing. There are always opportunities inside every single market, no matter what the market is doing. The greatest gainers, top 100 past 24 hours, Rune, ASTR, Monero, GMX, TON, Tron, Link, and Synthetics. The greatest losers, past 24 hours, top 100, Solana, XDC, Mantle, Conflux, EOS, DYDX, Neo, and Stacks. Always remember Rule 4. Price is always moving in a wave. It's always going up and down. It will go up when the markets are in a down wave, and it will go down when the markets are in an up wave. It's very important to remember this rule. Sanjeev said from Twitter/X, the CTKS service has me in sync and my trend knowledge is better than ever. I'd like a few videos on timing. The inverter episode on Wing, that was yesterday's video, was a game changer for me. I learned so much. I'd like to improve my knowledge in pattern recognition and finding the market's focus. Thank you, Sanjeev. One of the things that you can do, and it's very important to do, always look at your Tier 1 charts as you've been doing. Also look at the Tier 2 and Tier 3. If the major indices are starting to weaken, that is, the Nasdaq, the S&P 500, look for inverters. If you're a masterclass student, use the Bitcoin gearing indicator. It's very powerful. The next thing that you want to do is look at total crypto market cap. Understand you know where the structure is, but more importantly, where the three-dimensional risk management paths are. We can see inside total crypto market cap, we have a little bit of negative price momentum, but we're not following the negative path. You may think that because the S&P 500, the Nasdaq, is coming down, the total would be hit more than it is. But we need to let the charts speak their own truth. Always zoom in and make sure you pop on your indicator to see where smart money is buying and smart money is selling. These safety nets and ceilings are very important, especially in crypto. Crypto is so incredibly volatile. If you don't know where the safety nets are, you're likely to fall straight into the floor. And if you don't know where the ceilings are, you're likely to buy when you should be actually selling. We can see inside total crypto market cap that $1.019 trillion smart money buy area, marked up with the CTKS method since 2014, has been fantastic. We can also see the structural sell level at 1.026 trillion and a little bit further up, 1.028 trillion. They're both quite strong. We're looking for total crypto market cap to make a decision on where it's going. So far, it's just following a consolidation path. Market intercorrelations and chart intercorrelations are consistently moving around. That's why it's important to keep a handle on what is occurring inside price reality. When we look at Bitcoin, it's currently trading at 25,727. When we throw our three-dimensional risk management price paths on it, we can see that Bitcoin is like total crypto market cap, just following a consolidation pattern. When we turn on the CTKS method structure indicator, what do we see? Bitcoin is a long way below the smart money sell level of 26,297, and it's also a little bit closer to the smart money buy area at 25,364. What does this actually mean? It means that Bitcoin is currently getting its momentum from total crypto market cap. It has been the other way around for quite some time, but this is how the markets change. It's absolutely fantastic to answer your questions in the daily video. Please reach out to me on either Twitter or X, or you can leave a comment in the YouTube video. I'd love to see your questions and incorporate them in upcoming videos. Inside financial markets, it's absolutely critical to have knowledge. The reason that you need knowledge is you cannot guess. You must know. One of the fastest ways to know is to understand the intercorrelation and interconnection between charts. That's a very powerful first step to get synchronized. Then, by knowing where smart money is buying and selling through the CTKS method, it's an absolute game changer. But I would suggest one of the most important things that you can do is to maintain a positive outlook. You'll need this primarily to combat the news. The news is just literally always doom and gloom. In fact, certain YouTube channels don't talk about anything else. They're eventually hoping to be correct, but unfortunately, what looking at that kind of news does, it just keeps you out of the market, and you'll get pulled into the market at the wrong time. You'll get pulled into the market when things look certain. There is no certainty inside financial markets. What we do is that we stack intercorrelations and probabilities. If you look over the past videos that I've done, you can see that I've done many trades when the market is blood red. I only share these trades because I want you to gain more confidence to understand the red is not your enemy. Red days are particularly powerful, but they're very hard to take advantage of if you think with a retail or emotional mindset. That's why we have the CTKS creed, and I believe the most important part of this creed is I win or learn and never blame. If you get something wrong, it depends on your time frame. A lot of people say, how do I get out of a bad trade? Maybe it's not a bad trade at all. Possibly, maybe it is. But maybe it isn't, and you just need more time. With knowledge and experience, you'll be able to understand if it is in fact a bad trade. I would love to hear your questions of me in the comments. And we can talk about those questions that you have inside the daily videos. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.